5.5 billion in losses, only from a single client. This is how much Credit Suisse, a large international bank, lost a few years ago. Yes, from a single client. The reason? Bad risk management decisions. A few years later, Credit Suisse ceased to exist as an independent bank. It was at the time one of the largest banks in Switzerland and one of the largest banks within the European Economic Area. It was acquired by UBS, another large Swiss bank, after years of losses, scandals, regulatory issues, and declining customer confidence. And we are not talking about a small bank. We are talking about a bank with established customer base, with established risk committees, internal and external auditors, sophisticated systems, regulatory oversight. Yet it still happened. And why we should care? Because if a global bank with all these resources can experience a failure at this level, every organization should pay attention, because it can happen to any type of business. The risks may be different, the industry may be different, but the lesson is the same. Now, risk management is valuable when organizations understand the risks they are facing and take action before these risks become a reality. Let's start with the client that resulted in 5.5 billion in losses, because this was only one of the issues that Credit Suisse faced at that time. Credit Suisse had a customer named Archegos Capital Management. Archegos was making large investments using financing from several banks, including Credit Suisse. Now, Archegos increased the size of its investments, and as a result, Credit Suisse increased its exposure to this client. So what Archegos did was actually taking big investment risks, relied heavily on borrowed money, repeatedly exceeded the internal threshold set by the bank, and it became a large source of risk for the bank and the other banks that lent the money to this company. After years, the independent investigation that took place revealed that there were warning signs that Credit Suisse did not take into consideration throughout 2020 and 2021. At some point, the investments made by Archegos started losing value. As losses increased, Credit Suisse became concerned because Archegos did not seem to be able to meet its obligations towards the bank. And those concerns proved correct. The situation deteriorated very quickly. And when everything was over, Credit Suisse announced a loss of 5.5 billion from a single client relationship. This is where the investigation becomes surprisingly interesting. Investigators found out that the warning signs have been identified by the bank because it did have risk management frameworks in place. Concerns have been raised. Risk information was available. The challenge and the failure was turning this information into action. In other words, the warning signs continued over time, the concerns continued to be raised for some time, and the risks continue to grow. Yet they didn't do anything about the relationship. They continue the relationship. The problem is that the organization failed to respond to the information it already had. One of the greatest issues of this case is what we call concentration risk. Concentration risk means that a large part of the organization's success depends on one thing. In that case, one customer. But in real life, it can be one customer, it can be one supplier, it can be one product, one market, one source of revenue. But in this case, in Archegos' case, the bank lent a lot of money to a single client. The failure of that client resulted into huge losses for the bank. And when that client failed, of course, the impact was enormous. Now, many organizations face concentration risk without realizing it. Maybe the customer is different, maybe the market is different, maybe the supplier is different, but the principle remains the same. Now, the Archegos case was only one of the challenges that Credit Suisse faced at that time. Around the same period, the bank was dealing with other significant issues. One of them was Greensill Capital, another customer. Credit Suisse created funds, investment funds, that purchased assets connected to Greenseal's business. Those funds grew approximately to $10 billion. So when Greensill collapsed in 2021, Credit Suisse was forced to suspend those funds. Investors were waiting to see how much money they would be able to recover. Now, at the same period, the bank was facing additional issues: regulatory investigations, compliance failures, anti-money laundering related issues, governance concerns, and negative news headlines. Each issue raised new questions on how the bank was managing risk. Now imagine you are a customer of Credit Suisse. Over a period of years, you read headlines about Greensill, Archegos, regulatory issues, anti-money laundering failures, governance concerns, and multiple losses. Eventually, you start asking, is my money safe with that bank? And this is where the confidence problem started, because trust is one of the most valuable assets a bank has. Customers place their money in a bank because they believe that it's safe. In this case, as confidence in Credit Suisse started to weaken, customers started withdrawing their funds. Over time, more and more customers withdrew those funds. In March 2023, after the completion of the audit process, Credit Suisse announced internal weaknesses in the controls over financial reporting, coming after years of losses, years of investigation, years of negative headlines. The announcement hit investors, the announcement hit the customers, and overall the market. This announcement came at a time where the trust in that bank was already fragile. Customer withdrawals accelerated, pressure on the bank to meet these withdrawals increased, because banks do not hold all their depositors' money in readily available cash. They use this money to give out loans, to do some investments, and some other banking activities. Under normal circumstances, this is not a problem because not all customers want to withdraw their money at the same time. But in this case, as customers' withdrawals increased, the pressure on Credit Suisse was also big. And this creates what we call liquidity issues. The Swiss National Bank provided liquidity to the bank in an attempt to stabilize the situation. But a few days later, the Swiss regulators announced the acquisition of Credit Suisse by UBS. Yes, after more than 160 years of existence, Credit Suisse ceased to exist as an independent bank. As already explained, the official investigation revealed that the information was there, the risks were known. The problem was that this information was not translated into action. And this raises an important question. What can organizations do to avoid finding themselves in a similar situation? The first one is concentration risk. Ask yourself, are we becoming too dependent on a single client or a single supplier or on one product, one market? Second, pay attention to warning signs, because many organizations have the information but only a few act on it. Third, create a culture where concerns can be challenged and escalated. People within a business should feel comfortable to raise questions, even difficult questions. Fourth, review your risks regularly, because the risk profile of an organization, of a business in any industry, changes as business grows. Finally, remember that risk management is not a reporting exercise. The purpose of risk management is to support decisions. And this may be the most important lesson from Credit Suisse story. A global bank with experienced professionals, sophisticated systems, established risk management frameworks, lost approximately $5.5 billion from a single client relationship. So if this can happen to a large international bank, every organization, every business should ask, are there any risks within our organizations that we know about but we are not addressing?